Let's begin this next panel. The panel is being moderated by Jose Antonio Ocampo, and who I've asked to undertake the impossible role of both moderating, chairing, and speaking. But the reason why I have to give him that role is because he's one of those people that through his career has sort of effortlessly spanned the heights of both academia and policy making. Jose Antonio was Minister of Finance in his own country, Colombia. He's been Undersecretary General for Economic and Social Affairs in the United Nations. He was head of the Economic Commission for Latin America. And at the same time, he has won awards for his scholarship. He won the 2008 Leontiev Prize for advancing the frontiers of economic thought. He won the Alejandro Angel Escobar National Science Award of Colombia. I could go on, but then we wouldn't get to the panel. So, Jose Antonio, it's such an honor and a pleasure to have you here, and thank you for agreeing to lead this panel.
Thank you, Nadia, for the invitation, and I'll try to play these potentially inconsistent roles of a speaker and a panelist and moderator, as well as I can. Listening to the last panel, the impression I had was, these people are, excellent panel. They're talking about how to manage excessive finance. For developing and emerging economies, the problem is actually the opposite: how we build finance. So it's an interesting contrast, but also the challenges are somewhat different. So the first issue that I think is important to recognize is that Basel III has one sort, of course a lot of implications for us, and in the right way, the capital, the liquidity of financial institutions. There was probably not so much talk about provisions or reserves of financial institutions. There is a question of ring fencing, of too big to fail, et cetera, et cetera. I mean, those issues are certainly relevant, but I will underscore the fact that what is really specific about finance, risk in developing countries is the mix of maturity and currency mismatches. The fact that there is not enough long-term financing, so a lot of long-term financing is done through the rollover of short-term debts, which is a risk for the banks and for the firms that do that kind of finance, get that kind of lending. And also, and very importantly, currency mismatches, which is something that very interestingly doesn't figure almost at all in the discussion on Basel III, okay? And which is has really been a major source of problems in many emerging economies and developing countries. Even some, I guess, some Central European countries that continue to borrow for households borrowing foreign currency. So sometimes the risk is incurred by the financial institution, by the bank, and sometimes by the people, by the households, or the firms. So I think that's a very important issue. And how to manage that. And I think, and this leads me to my second point, which is the link, which is not quite recognized. It's certainly out of the remit of the Financial Stability Board, of the question of the relation between capital account management and financial management in countries. I mean, this week was actually interesting because the IMF, which has been the institution which has been discussing this issue of capital account management, actually, as taking the words of the Financial Times, make a U-turn on capital account. Actually, not a U-turn. Actually, according to the IMF, any country can regulate its capital account the way it wants. So there was never, in a sense, I mean, what happened is that formally, there was an agreement that capital account regulations make sense at different points in time. But much more than that, I think what is very specific, the major advance in regulation in many emerging economies is that they're much better today at managing the currency mismatches, or actually at avoiding currency mismatches to a large extent. So many of those regulations are not direct capital account regulations. They are not domestic financial regulations. They are actually about how to manage the risk associated with the management of foreign exchange in the domestic markets. For example, whether you can borrow in a foreign currency or not borrow in a foreign currency. If you borrow on foreign currency, what are the requirements for that purpose? And there are very interesting innovations. I mean, one that I actually like very much in Latin America, which is actually the case of Peru, which has a dual a system which partly dollarized, a financial system in which the reserve requirements on liabilities in dollars are entirely different and managed much more actively than reserve requirements in Nuevo Sol, the domestic currency. Other countries like, for example, like Chile and Colombia or even Brazil have a long-term tradition of trying to avoid domestic lending in foreign currency, which is a totally different. For example, my country has a very good rule which has always been in place, which essentially forbids banks from holding net assets in foreign currency. Okay, so essentially they have to match perfectly assets and liabilities. So the issue relation with capital account regulation is also very important because the capital account is the major source of booms and busts in emerging markets. So what you do with that, and I think that's what the IMF was meaning this week. Now, the third issue, which probably Guillermo can, based on his experience, can make a point, is a complement actually to the discussion this morning about development bank, which is about building bond markets, capital markets. I think one of the major innovations post-Asian crisis was the huge development of domestic bond markets in domestic currencies. I mean, sometimes also in foreign currency, but largely in domestic currencies. And I think that fact by itself is one of the major facts of resilience of many emerging markets during the recent crisis. What can be done in that regard, I mean, what has been done is a very important issue, how to regulate that, what domestic agents are active, with, for example, the pension funds being, again, Guillermo having been superintendent of pension funds in Chile, it's interesting. So they are, you create markets, and how you create those markets. And however, those markets develop much easier for government bonds than for corporate bonds. I mean, so the development of corporate bond markets is still an unfinished business in most countries that even have relatively large corporate bond markets. The fourth issue that I wanted to underscore is access to finance, which is a major issue in every developing country. How you get small and medium-sized enterprises, micro firms, poor households, have access to finance. And there, some of the innovations in this regard, come from totally outside the financial system, the microfinance institutions, some cooperative systems, many other non-financial institutions, which raise, an interesting question regarding the, how you regulate those institutions. Those institutions have, need regulation of some sort. Is it the same as financial regulation in general? It's a totally different regulation that you have to put in place. I mean, generally, the legal system somehow have, like different categories for different agents, and some of these are not subject to financial regulation, but should they? And more generally, what can the state do to promote access? And in relation to both development and financing and access, I mean, I think the role of public sector banks, even beyond development banks. I mean, in many countries, for example, it has been assumed historically, for example, that rural credit should be in the hands of the state. Even say in my country, which still has an agrarian bank as the only private, first tier banking institution owned by the state. For example, that institution is almost considered to be part of the payment system. It's a way of getting, payments in the remote areas of the country, which is probably a role for the state. Who else can play that role? Now, of course, there are many innovations, African innovations, actually, about the payment system that maybe with the, cell phones payment that, can probably, have discovered a new system, but, so far, and then more generally, what is the role of public sector banks? I'm pretty sure that Martin will make some points based on the study of the World Bank. And finally, the point of governance. In the past, we were recipients of regulations. We were told to adopt, the Basel regulations. We have without any voice in the Basel Committee. Now, of course, the Financial Stability Board and the Basel Committee have expanded. They have the emerging economies, but my country or Guillermo's country are outside that regulation. Which makes it a very funny system in the world. That there are the regulators of the world, with no participation of many countries, many emerging economies and developing countries. So, what system should be envisaged? Is that system okay, or should we really move to a universal type of regulatory organization to solve that system? Okay, with those comments, let me then give the floor to Martin Cihák, who is the lead author of the Global Financial Development Report of the World Bank, which is going to be a PowerPoint, so I'll actually move to see it.
Thank you for the introduction. And, just a few slides because I have some nice charts I want to show. But let me clarify one thing to start with. So my name is Martin Cihák. Yesterday there was Martin Rama, also from the World Bank. And our former boss is Martin Ravaillon. So some of you were asking me, some of you students want to go to the World Bank. And so it's not a requirement if you want to write a report that you need to be a Martin. So you can even without that. My presentation very much sort of relates to the previous two sessions, so it picks up on some of these points. So what we did, and unfortunately it seems like all the copies are gone, so I brought copies of a report that we recently released. It's called the Global Financial Development Report, and this is like a first in a hopefully series. It's an inaugural issue of the report. And part of the idea for this report is precisely the point that Jose Antonio just made, that there has been during the crisis this shift towards focus on financial stability in advanced economies, and for good reason. But to some extent that has sort of detracted from the important point that financial development has a major effect on people's lives in good times, and oftentimes that's less visible. So what the report tries to do is to bring that point home and also bring together some of the evidence and data that we have for the broad membership of the World Bank. And really the emphasis here is more on developmental issues and on emerging markets. In this sense, the report is kind of a complement to the IMF's Global Financial Stability Report, which is semi-annual. Our report is an annual report and has a bit more sort of underlying analysis and papers coming with it. So what we are doing with this first one, we wanted to look at the role of the state as one of the issues sort of really highlighted by the crisis. And I'm glad that Jose Antonio mentioned financial inclusion, because that's actually what we are starting to work on now for next year. So we have a number of papers that we've been working with colleagues on barriers to access for small, medium enterprises, barriers to access for households, and we have some new exciting data on demand side on barriers to access. And the next one, which is not here, will be most likely on developing local capital markets. So for those of you who didn't get the hard copy, I should say that it's actually all on the website, so you can download not just the report, but there's a really massive data set coming with it and several surveys. We did like a pocket version that I brought in my pocket, so maybe some of you may have that. It's called Little Data Book on Financial Development. Now, I'm not going to go through it. This is just to impress you with the size of the database. part of the report really explained that financial development really matters as impact on poverty and economic. To some extent, it's been controversial, and there are some issues on how we actually empirically measure the theoretical concept of what is financial development. But I'm not going to bore you with that. Let me just say that it covers about 205 jurisdictions starting from 1960s. It's annual data. So if any of you are trying to do some cross-country research on linkages between financial sector and so this should be the place to go. There was a number of partial data sets. So what we've done is we really put it onto one umbrella and added quite a bit of data. Also, the website allows you to do some pretty cool visualizations. So this is just one example, and that's part of the reason why I'm showing the slide. So you can show your friends how your country really looks if you try to adjust the size for the size of the financial sector. So you see, if one of you is from Luxembourg, it's actually bigger than the whole sub-Saharan Africa, or funnily, I mean, Alaska looks very big because it's just, like the US doesn't distinguish, so Alaska looks bigger than sub-Saharan Africa. So with this, let me now focus on the other 4 chapters of the report, which look at various roles of the state. So if you look at the top, you don't see the top. So I'm going to talk about 4 roles of state: regulation, supervision, competition policy, direct interventions, and role of state in financial infrastructure. And just a few points on this. So it's a very broad topic, and it's part of what we want to say. We want to say that the role of the state is not just development banks or just state-owned banks. It's much broader, and there is an issue of sort of rebalancing these roles. One part of the report is we've done a sort of informal global survey where we ask for people's views on financial development, but also their views on some potentially controversial topics on the role of the state. And the interesting thing is, when you ask a hypothetical question, can state-owned banks be helpful, you get 95% respondents, and these are usually like supervisors, mid-level officials in ministries of finance. 95% would say yes, state-owned banks can do their job. When you ask, well, do they actually do it, the views are much more split. So it's about, if you ask, were they helpful during the crisis, it's about 50-50. So here from the survey, which had many more questions, I just picked a few where the views were about evenly split. So these are the kind of topics that were discussed in, to some extent, the previous panel for advanced economy. So it has, for example, the issue about stringency of supervision or how wide you want to have your perimeter. Those are the kind of views where we got about 50-50 split. Or when you ask about competition, about 50, I think it's 58%. 58% said yes, I need to have more competition. The rest said no. So let me start with the role of the state as regulator and supervisor. So here I'm picking up on the previous session. Well, one of our contributions here is that we did a survey, which this is the 4th running of the World Bank survey. It started in early 2000s by Jerry Caprio and Ross Levine and Jim Barth. So this is a worldwide survey on regulations in bank supervision regulation. And what we've done is we sort of cleaned it up and expanded, and this is really the first time it's done after the beginning of the crisis. So it allows us to do some comparison of what it was before, what it's after. Well, if we are after, what is it during the crisis? So again, just a quick chart. It sort of underscores in some ways what was discussed for the subsample of advanced economies. We say that really definition of capital, how wide or narrow definition of capital is. So the countries that ended up in a crisis were much more likely to be countries that had sort of wider, that allowed more stuff to be put under capital, or countries that allowed their banks to calculate themselves what the risk weights are. So this sort of underscores what was mentioned in some of the speakers in previous. I should say that this is, again, it's worldwide, and we are using definition of crisis, non-crisis that's been used in previous studies. So we are not making up. So here, Levin, Valencia, they have definition on what is a crisis. US, UK, are obviously examples of countries in crisis. Now, just to summarize, I mean, the data set has about 600 questions on the various aspects of supervision regulation. How many banks did you close? How many licenses have you received? How many have you rejected? And what we found, by and large, is that the crisis hit countries, the ones that ended up in crisis, tended to have much weaker regulation and supervision practices. Again, it's not very surprising, but it sort of confirms what was mentioned in the previous panel. But we also find that they had much weaker incentives for actually monitoring banks' risk. So the ones that end up in crisis tend to have more generous deposit protection coverage, deposit insurance systems. They also, perhaps somewhat surprisingly, have a lower quality of published financial information. So of course, the US has relatively high, but if you look at, at all the crisis countries, this is what we find. Overall, this sort of, again, goes in line with what the previous session said, although it seems to be a difference with the complaints of the banks. So what we find is that most of the responses have not really changed much between 2007 and 2011. So most of the regulations, most of the features of supervision have not really changed between 2011 and 2007, despite the proclamations and the response from the banking sector. What we see is clearly, if we focus on macroprudential policy, crisis resolution, consumer protection, these are the areas where a number of countries introduced new laws on special resolution regimes. But this is only a small subset. If you look by and large, 85% of the responses are the same. And there's clearly a room for improvement, especially on the sort of incentives to monitor risk taking. Just briefly in the same chapter, we also look at some of our evidence from country work, where we go into countries and do these assessments of compliance and standards and codes. And one of the common threads in many of our countries is that it's simple, or less can often mean more. That is, the issue is that sometimes the countries, in an effort to implement Basel II, they don't have the capacity to implement. This brings me very quickly to the role of competition, and here I would dispute one of the claims made in previous session that it's great to have a more concentrated system. We find the exact opposite, and sometimes people mention this example of Canada. Look, Canada had a concentrated system, it's great. Well, it's true that Canada was one of the countries, and historically a country that avoided crisis, but it was not because of the concentration of the system, and we studied more carefully. It had more to do in the case of Canada with the wholesale funding that was, they were much more prudent, etc. We did, again, cross-country analysis of measures of competition. This is part of the database. So if one of you wants to do something on an analysis of competition, this is for the first time you can have, for example, a Boone indicator for banking systems for a large number of years. And what the analysis says, it really is not, the competition is not the culprit of the cause of the crisis. Sometimes it's portrayed. It's really, again, the underlying regulatory failures or failures in, ensuring healthy entry and timely exit, problems with contract enforcement. So it comes out quite strongly from the evidence. When you try to run regressions, it's not the competition doesn't necessarily correlate well. What correlates well with competition is issues of access to finance. You find that if you allow more competition by non-banks, if you allow you have better access to finance, you also tend to have more efficiency. But if you try to look at competition and stability, it's a sort of there's no direct relationship. Now, direct state interventions, again, it's a part of this whole rethinking, and part of the reason why we are looking at it is because during the crisis there's this idea that, okay, when in countries where you have state-owned banks or development banks, maybe you can use them as a counter-cyclical device. So we didn't revisit the whole debate on development banks in this paper, but we zoomed in on this issue of counter-cyclical lending in crisis. And we got criticized from both sides, so I guess we probably struck the right balance. But what we found, sort of the new evidence from this crisis is that there is some evidence of counter-cyclical lending if you look at the broad sample of banks. So the public-owned banks, and we did various robustness check. You only look at development banks, banks that are state-owned, commercial banks. We tend to find they are at least less pro-cyclical than the private sector banks. And in fact, if you break it down for a subsample of countries with sort of more advanced countries, you see that they're actually counter-cyclical. We also find it depends quite dramatically on the broader institutional environment in the country. And this is the heart of the problem. I think somebody yesterday mentioned, oh, it's not clear what the policy guidance. I mean, the guidance is actually pretty clear. I mean, there's a number of papers from the World Bank, from the Inter-American Development Bank on what are the good practices. And as part of the work on this report, we did a survey of these development banks, and about 90 of them. So it's pretty clear on what these good practices theoretically are. I mean, the problem is that the countries that would benefit most from this kind of intervention are also the ones where so these sound corporate governance practices, adequate risk management, sustainability of mandate are less likely to be in place. I mean, there are exceptions, but it's clearly not as simple as exporting the Canadian Development Bank from Canada to somewhere else, which is, by the way, a very small bank. Yeah, and this is the last point. This is actually the most boring part of the report. It's probably the most boring part of all the presentations, but it's very important. This is about the plumbing of the financial sector, and so I'm just we have another section that deals with why interbank market froze and how to promote securitization. But here, the point here is the issue with large banks and more concentrated system goes beyond this idea of more stability, or it goes beyond the too big to fail. What we found when the data you can find on the website, we tried to look at what determines whether a country ends up with a credit information sharing system, whether banks are able and other utilities, whether they're able to get credit information. It depends quite a lot on the concentration. If you're a concentrated system, you're much less likely to find, not only with a privately done credit bureau, but also less likely to see a credit registry. In fact, you're less likely to see any form of credit reporting. So if you look at on the right side, this is like high bank concentration. When you have very high degrees of bank concentration, only about 50% of those countries have any form of credit information sharing. Now, what's the report about? It's pretty broad. If you ask me for the 30-second version, it's really about the balancing of the roles of the state. So what we are saying is you shouldn't only be looking at the state ownership of banks. I mean, that's part of the motivation. But the point is many of the countries, and some of them we just saw now, on paper they had a mostly privately run system, but during the crisis there was a lot of state intervention. So the point is it's really rebalancing those different roles of the state as regulator, as owner. And so what we are trying to make a case for is sort of a case for rebalancing. And it goes into sort of achieving the right balance between sort of public interest and the private incentives. And that's something that has not really been fully addressed by the regulatory reforms or by sort of improvements in governance of state-owned banks. All right, thank you very much.
To Guillermo, who actually had the possibility in his career to be superintendent of two parts of the financial system, yes. The pension funds and then the capital markets. So
and insurance.
And insurance, right.
Let me first thanks Nairi for the invitation. I'm really glad to be here. Thanks Tom and the whole team for setting up this very, very useful conference, I think. Let me start by governance issues that were mentioned by Jose Antonio and by Martin as well. And these opinions are based on my experience as being members of the IOSCO Emerging Markets Committee, chairman or member of the board of the IAIS, the insurance regulator, and the IOPS, the pensions regulator. So I have a lot of experience in those things, and I was also a member of the Financial Stability Board. So what's the governance of the international standards which are actually being designed, implemented, and applied in many countries? Well, it's the outcome of a very complex political process. So what you basically have is a compromise between large financial centers, not necessarily what we would call a rational decision-making process. There are no really experts which are debating which are the best standards. This is a political negotiation among the large financial centers. These have three consequences, two in terms of governance and one that will affect directly the emerging markets. One is that it's very difficult for large financial centers to make honest self-assessment of their current situation. Because any assessment, because this is a political compromise, any assessment of the degree of compliance of any large financial center with those standards will show that they fully comply. And that's what's precisely happened before the crisis. So when you look at the degree of compliance with best practices before the crisis, in the case of the US or the UK, and they were fully compliant. There was no mistake, and there was a crisis. So there is a problem of governance, of how standards are designed, how they're set, that it's important. We later on used the FSAPs, and now today the US and the UK and China are being subject to FSAPs, but they use the standards as the lens by which they understand whether or not the financial systems comply or not with best standards, and guess what? They are fully compliant. So we have a problem there, and we need to address that. I don't have any particular suggestion at this regard, but there is a problem. Now, from the perspective of emerging markets, there is an additional problem. Is that those standards are applied worldwide to, let's call, tier 1 companies. So you say that the securities standards are basically applicable to listed companies in developed countries. And that's fine. So the problem is that the same regulation is applied later on to emerging markets. To which companies? To tier 1 companies in those markets. But tier 1 companies in an emerging market is much more similar to a tier 2 company in developed markets, which is not basically following the same standards as tier 1 companies. So, and you can see that in the application of different the regulations for listing companies and exchanges, or the IFRS for SMEs, etc. So we have a problem there. So the international standard setters are requiring emerging economies to apply standards to their cases, to small economies, which are really applicable for large corporations in developed countries. And there we have, I believe, a governance problem. Now, the panel is called Financial Changes and the Emerging World. So I would like to discuss a little bit what is going on currently in emerging markets, but in particular in Latin America, which is where I'm working the most. I'm also working quite a lot in Africa, but I will basically talk about Latin America. There are very important things going on currently in Latin America, from Mexico to the south. There is an initial path of disintermediation from the international financial centers in two ways. One is that many large basically European financial institutions are quitting the continent, and they are being replaced by nascent Latin multinationals. And this is a very interesting process. Several of them are Colombian, other ones are Brazilian, and a small chunk are Chilean. But they are starting to cover the whole region, providing services in neighboring countries. That's really important. What will start happening from now on is that there will appear, or they will be strengthened, regional financial centers. So many countries, including my own, for several years have tried to develop a financial center in Santiago. But that took place, and those conversations took place in a very different setting, when London and New York were really the major centers, undisputed. That today is not longer true. And regional financial centers are starting to develop, and cities are starting to have strategies to become regional financial centers. You see that very clearly in the case of Brazil, in Sao Paulo. You can see that also in the case of Colombia, Lima, and Santiago. Mexico, a little bit less, because they are much too reliant still on New York. But the idea that you have regional financial centers that will be developed over the next couple of years, and to some extent they will disintermediate the larger global financial centers, is something that will certainly take place. Now, this process has implications and in several respects. One has to do with capital flows, which is linked to what Jose Antonio was mentioning at the beginning. So what is the proper macroeconomic policy mix that these countries should have in order to really to use this new emergence of local capital, which is moving across Latin America in a more productive and safe way? And countries seems to be converging to something which is a mixture of flexible exchange rates, almost non-capital controls, fiscal conservatism, and inflation targeting. That's the basic recipe that all countries are more or less following. And of course, any of those particular areas have specific challenges that we can discuss if you want later on. From a regulatory point of view, there are some interesting things that will start happening. Emerging economies, but in particular Latin America, are, as you well know, commodity-driven economies. And as such, they do not trade much among themselves. So Chile produces copper, Peru produces copper, so what can we export to Peru? Well, not copper, because they produce it. So it's very difficult, and the intra-regional trade is increasing because, of course, there are developments. We produce something more than copper, but it's a country, it's a region in which, so to speak, cross-border risk transfer is totally new. For you to have an idea, only in the last year, in the last 12 months, in the case of Chile, we were quite accustomed to be exposed, so to speak, to the Spanish sovereign risk because we have two large Spanish banks in our economy. These banks are still there, but we suddenly find ourselves exposed to Colombian risk because we have two large Colombian entities serving our financial markets, one large Brazilian bank, and that's the same happening elsewhere. In Colombia, a Chilean bank has bought already two banks, and they merged. So the cross-border risk transfer is something new, something that is not included in our current legislations, in our current regulations. It's not even in the mindset of the regulators. It's something that is totally new. It has only 12 months old. So we hope that we can be able to learn and to understand what happened in Europe and what happened during the crisis, but that will certainly take place in order to be embedded in regulations. So there is some learning and some learning that will take place, but at an unknown cost. What happens if tomorrow China decelerates a bit harder than expected, and commodity prices fell too much? What will happen to that risk? I mean, I'm not sure, and the cost it's unknown. Now, in terms of domestic institutions, I believe there are also some important challenges. As much in the rest of the world, most Latin American countries are creating financial stability councils and they are creating consumer protection agencies. But beyond those two areas, there are no major institutional changes. What does it mean? It means that the regulatory framework is basically the same one that we had before the crisis. In particular, with the exception of Colombia, we have what we call the silo approach to regulation. So you have a regulator of banks, a regulator of securities, another for pensions, and another one for insurance. But what we all know is that financial institutions no longer have very clear definitions. A bank, what is a bank? Where the bank starts and when it ends is not clear. So we are currently facing a problem that those nascent multinationals Latin multinationals are widespread all over the financial sector with very narrow scope for those regulators that will be overseeing those institutions. And this has, I would say, three implications. One is something that you all know well in developed countries, regulatory arbitrage. So these companies, they will optimize their operations, and they will develop their business where the regulatory charge will be smaller. And that's a problem. There is a problem of too big to fail and too interconnected to fail issues. These are very large institutions. Someone, I believe that Adler Turner mentioned that Citi in the US, was John Vickers, was smaller as a share of the total economy than Royal Bank of Scotland well, you cannot imagine the size of the Latin American large banks. Are incredibly large for the size of the economy. So this too big to fail and too interconnected to fail is very important. And this is one question for you, Martin. What do you mean by healthy exit in that context? It's important. It's not clear. And the other point is that the regulators they have a very weak institutional framework. And therefore there is another risk of regulatory capture. Not necessarily corruption, but capture, intellectual capture, influence. And therefore we are in a process, a more integrated economies, a much more larger capital flows among Latin American countries, but the local regulators find themselves with weak governance. And just to finish, there are two important initiatives now in the securities market, which are important to mention. One is the integration of the stock exchanges between Colombia, Peru, and Chile. This is a totally new development in the last 3 years. It is not a real success for the time being, but it will eventually be so in the future. The Brazilians are discussing with them in order to create a large Latin American integrated market, and this is part of the process of disintermediation or potential disintermediation of the large global financial centers. So there is a lot of activity going on in Latin America, a lot of challenges, a lot of risks, and we hope a lot of rewards as well.
Okay, thank you. So, Guillermo, your first point is one of the jobs I have now is in a panel that is reviewing the activities of the IMF Independent Evaluation Office, and they actually produced last year a really interesting report on the IMF surveillance in the run-up to the crisis, and which is a very, very interesting report about the total failure of the IMF, but also the authorities of the US and the UK of identifying risk in those economies and the incapacity of the IMF to really face. While interestingly, the IMF identified, for example, risk in Switzerland or in the emerging economies, which particularly emerging economies did not have any, face any major risk. So, I mean, this point about who identifies risk in the industrial economies is a really major topic. I think let me open it to questions and comments from you. Yes. Do you have microphones here?
Cornelia Meyer, one quick question on, is this working? Yeah, I think so. On the access to finance, and as you very rightly pointed out, I mean, it's not everybody is banked in many emerging markets, and in many of them, if I think of countries like Morocco or so on, you have the remittances are such a large part of the finances of the country, of the economy, and they usually go through the non-bank sector. What in your view can be done to make the non-bank sector get more mainstream? Does it have to happen, and how would you regulate it? Because in the end, if you have it more mainstream and get more people banked, that has also big, good ramifications for building insurance sector, pensions, and obviously collecting taxes.
Okay. There was another question here. You had a question, yeah, here.
My question was picking up on a theme from earlier about the consequences for developing country financing of Basel regulations, which, if Peter Sands is here and wants to correct me, feel free, but I believe he argued in the first session that the restrictions on leverage requirements and derivatives packaging would make it harder for developing countries to get finance, and thereby arguing that the regulations actually harm the people who most need the help. And I was wondering if you could address that claim.
Here, two questions here.
All right. Yeah. Thank you. Yes. Guillermo mentioned a good deal about the changes that have taken place or are taking place now. But I would ask about the changes that need to take place, particularly in Latin America for the future. For instance, regarding financial markets, if the Colombian and the Chilean and the Peruvian financial markets are trying to merge, is also because they are so small and so inefficient internally. So one of the big questions is how to develop them, not just institutional, but also in terms of how to incentivize companies to participate, and that I think that's a very big question, which nobody has offered answer so far. But also in terms of investment, for instance, another big failure in the case of most Latin American countries is the complete unavailability, for instance, of venture capital, capital for long-term investment, particularly if we're talking about development in the connection with another panel. Science and technology investment in Latin America is a critical point, and it is not that there is no money. There's money, but that money doesn't go where in some cases it should go. And another point, again, which probably relates to all this, is also the rise of this huge multi-Latinas, as they're called, but which again are working on the so-called traditional sectors. So you've got lots of movement, lots of action, and lots of interesting emerging strategies, but still in traditional sectors. So how to incentivize changes towards the much needed activities in new different sectors?
Yeah. Why don't you pass the microphone?
My question is for Professor Larrain. Normally Chile is considered the model for economic innovation in Latin America, and I would like to address the issue of access to finance. I will skip the topic of funds for entrepreneurship because they are mainly grants and very limited amounts of money available. But in the case of the state Corfo, the Corporation for Development, there is money available for small and middle-sized enterprises, but at market prices. Yet when a company such as the Luxich Group approaches the state, it obtains money at virtually interest-free rates. So how can we create a culture of entrepreneurship when such contradictions coexist in the Chilean economy?
Okay, I think I'll give the floor to Jorge, and that will be the last here. The last one. Yeah.
Thank you, Jose Antonio. There is a fascinating issue which Guillermo brought up. Through which lens do we look at these issues? And you brought it in, Jose Antonio, when you said we are recipients of regulations. We are recipients of the global institutions of capitalism. And what Guillermo was telling us is that we are gradually developing our own kind of institutions of this new wave of capitalism. This goes much beyond the issue of the financial sector. I mean, in many other areas, we are simply looking at the North and trying to reproduce the institutions of capitalism, of mature capitalism, whereas Guillermo is telling us, okay, we are developing our own set of institutions in not that mature capitalism. I think this is a fascinating issue for development theory globally, not just financial aspects. And perhaps a plea up to say, well, we need to develop more theoretical understanding of what development is before we can proceed into specific areas beyond this issue of financial aspects. I would translate the whole debate, for example, in the international property rights today. I mean, a whole lot is being done of transferring the institutions of mature capitalism to intellectual property rights in developing countries, which, in my own way of reading it, it doesn't make any sense. It's very much in the idea that through which lens are we looking at this institutional development in our countries.
Okay, very good. Let me give the floor first to Guillermo, the reverse order.
Access to finance is extremely important. The experience in Chile is that this developed totally unregulated. And it grew to such an extent that it became, it poses now systemic risks. So it became regulated. And we have suffered some problems that justify this. So I'm not sure that it's a good idea to restrict the efforts of, or it's a good idea to avoid any potential firm that would like to provide services and therefore to induce access to the financial system just because they are not banks. We need to allow for that to happen, and institutions and markets need to find their way to provide those services, and I would say that regulation should come later once the market is already created. But if you start regulating the market when there is no market, that would kill it from the very beginning. So I would suggest let's have some process of trial and eventually errors, but some trial is very important in order to have people getting access. We have been extremely successful, I believe, in Chile in promoting access to financial markets at a large cost, and now today we have to come back to a more recent, a more decent level of cost. Now, when we talk about Basel III, your question, and here was seated the chairman of the CEO of Standard Charter. And of course, he just, the only thing he mentioned is the partial derivative. It is, of course, the new regulations will increase the cost. I asked him, how much will that be? And the final number is about 30 to 40% in the cost of if I remember well, an OTC product to swap copper something. Well, that's a number, it's an important number, but I believe that we must look the general equilibrium. If those regulations will increase the cost of that particular transaction, we need to compare that with the benefits that the whole system will obtain by having that transaction better regulated. And by having more information in the market, by having more safety net around all those complex derivatives. If we are able to avoid a crisis like the one we have just lived, I don't care about paying 30% more. It will be better for everyone, I think. So we need to see things in a systemic way, in a general equilibrium way. And when you discuss with many market participants, not all of them, but some market participants, they tend to approach the discussions in a very one-dimensional view, and that's totally erroneous, at least for regulators and for academics, I think.
Okay.
That's fine.
No, yeah, we have the time constraint.
Okay, we need to, okay. Only, we can discuss about the Brazil, the things of inducing, incentivize, you say, families or companies to come to the market. That's very important, but extremely difficult. I prepared a paper for the World Bank, an internal document for the World Bank, precisely on this, and it's extremely complex. People, the usual corporation in Latin America is held by a family, and what they see about coming to the market is just costs, just cost. It will cost on lawyers, it will cost on investment bankers, it will cost in terms of sharing information, in terms of contestability within the board, etc. So they only see the cost. There's a lot of learning, a lot of capacity building that should be done at that level. Because when we talk about financial literacy, we normally talk about people in the street. But there is a lot of financial literacy to do as well at the corporation level, people that believe they are very, very literate and they are not at all.
Okay, Martin.
I worked at the IMF in the run-up to the crisis, so I feel compelled to say something. I actually like the report. No, 2 points. I think one is on the international standards. I think, and it's a valid point. I think that the international standards should not be seen as something that prohibits the crisis from happening. I think that's a total mistake. The value is more sort of it sort of forces a discussion between the IMF, World Bank, and the country. But the standards by themselves. I mean, we did some studies. I was involved in the review of those standards. They don't really correlate with sort of performance in crisis. On the US, they actually got the grade in 2009, so it was after the crisis. But the way the standards are done, they don't allow you to capture problems in, for example, US insurance is doing very well vis-a-vis the standard, because there's, if you look at it state by state, the problem is they have 50 jurisdictions for insurance supervision, so that you don't capture by standards. Maybe one other point. So IMF performance before the crisis. I mean, now we're discussing European Banking Union. We had a paper in 2007 that proposed something called European Banking Charter, which was exactly what is being discussed now. So again, it's not. I don't think it was not that the advice was not there, but simply back then it was like, why are you even coming here? Why not talking to the emerging markets?
Okay, let me just refer to two issues. The issue of access. I think in practice, access you can get through, different institutions, and I think that's it's a challenge, let's say, to design a system that can absorb different institutions. It's done even in industrial countries. I mean, because industrial countries have different institutions, and some have failed. Like Cajas in Spain, for example, who just, from my point of view, one of the best systems in terms of access have just failed on a massive scale. I had to face actually, when in my role when I was minister, since financial regulation and supervision is under the Ministry of Finance, I had to face a major crisis of cooperatives, financial cooperatives, and I took the decision to bring them to the supervision of the banking supervisor. I think, and I must say, state banks can play a very important role in access, well managed, but they have their problems. I see less problems that the World Bank sees in the state banks. Actually, it's a question of corporate governance. Actually, one institution that runs relatively well in most developing countries are central banks, which shows that you can actually do build the institutions for, relatively well managed, even in very low development of institutional, institutions otherwise.
It needs to be independent.
What? No, they are not independent generally. I don't think, no, central banks are not generally independent. And they were not in the past when they were built up, and they, in most countries you go and the central bank is a relatively well-run institution. So you can actually do well-run institutions in low, institutional environments. I don't think that is correct. There are many good banks, the state banks throughout the world that, I think the World Bank tends to underestimate that. Access can be facilitated by state banks under certain conditions. No. I'm just making a statement. No, also state banks. there are many state banks that are well run. There are others that have been a disaster. I think it's a question of trying to see what are the requirements to make those institutions run well. As many cooperative systems or many microfinance institutions, there are many that do access to finance that that actually can play a very useful role, not only banks. And and finally, on the issue of this issue of who makes the rules, and I think it's a really major issue for developing countries because we are rule takers, let's say, in many areas, and I think the solution at the end cannot be any other than a multilateral institution in which of a universal character. I mean, that is my view. I mean, there was a panel run on the Financial Stability Board in which I participated, and run by Brookings Institution, and we came to the conclusion that at the end, the Financial Stability Board should become a universal institution at one stage. I mean, that should be part of the purpose. They are trying to do otherwise, to try to regional processes in which non-FSB members participate. But it's a very awkward institutional framework. At the end, it has to be a multilateral institution. Thank you, Nairi.
So just before you break, so far in this 1.5 days, we've looked at 3 areas in which governments have to get it right to galvanize growth: jobs, natural resource management, finance. 3 really important areas. We've seen that sometimes the policy ideas, the goals need to be clearer, and we've seen almost every time that the strategies of implementation need to be better and stronger. And that's an area that academics seldom step into and policymakers seldom have the time to pay attention to until they're well into trying to make their policies work. That's the area that we want the Blavatnik School of Government to step into, and that's part of why we host these conferences. The other part of the politics of what we've been discussing on galvanizing growth is what gives a government legitimacy to do any of these technical policy areas, and that's what we're going to move to in the final session at 2 o'clock this afternoon in a panel looking at democracy. So a group of the world's most eminent practitioners of democracy was assembled a couple of years ago to produce a report on how best to strengthen democracy. And so this afternoon at 2 o'clock we have Louise Arbour, President of the International Crisis Group, giving you a glimpse of that report. And then we have reactions to that report from 5 different places: India, Kosovo, Nigeria, Germany, and Yemen. A quick response to that report from some of the students currently working in the school about what it is from in their country or in their region would most strengthen democracy. So I hope you can join us all for that. We're extremely honoured, just before that debate starts, to have with us the Vice-Chancellor of the University of Oxford, who wants to meet you and thank you on behalf of all of us. So we'll see you all back in here at 2 o'clock. And for those of you who are leaving during lunchtime, can I just take this opportunity to let you thank not just the speakers, not just our partners who have been terrific, but those who have organized this conference: Thomas Hale, right here in front of me, Ed Long, Jolie Gibbons, Toby Whiting, and the whole Blavatnik School team, and students who have made this conference what it's been. So you can all thank them.